As someone who manages money, I'm seeing warning signs everywhere I look in today's markets, so it's time to get defensive. In this video, I'm going to walk you through a $600,000 portfolio I am building for a client. I'm going to show you how much allocation for each investment and what the investments are. I'm Michelle Hung, a senior wealth advisor, associate portfolio manager, financial educator, and author. If you watched my last video, you'll remember I walked through several key metrics showing just how overheated these markets have become, particularly the US markets. Now, while markets can stay extended longer than we expect, it's prudent to position more conservatively when some of these metrics, like the Shiller P ratio, are indicating to us that things are just a little bit bubbly. A bit of background, my client is in her early 40s. She won't be retiring for at least another 20 years or so she has a long time horizon. Her risk tolerance is moderate. So we'll be looking at an asset mix of roughly 60% equities, 27% fixed income, 10% alternative investments, and the rest in cash for liquidity purposes. Now let's zone in on the equities portion of this portfolio. Now, not all equities bear the same weighting when it comes to risk. For example, a single stock like NVIDIA is classified as an equity, but it's more risky than an equity fund like XDU, whereas XDU is the iShares Core MSCI Quality Dividend Index ETF. XDU would be considered a medium risk rating because it's diversified and holds 145 US companies that pay a dividend. Whereas a single stock like NVIDIA will be considered high risk because it's only one stock, not diverse. If something were to happen, the stock can drop a lot on its own or even be wiped out in the worst case scenario. So for the equities portion of this portfolio, about 60% allocation, 20% of this is going to be going into an equity pension fund, meaning companies that are generally lower in volatility and they pay a dividend. So there aren't a whole lot of the high volatility tech stocks. They don't really exist in this equity fund. For retirees that are looking for dividends and low vol equities, a pension equity fund will be really good for them. 25% in a growth equity fund. So in this fund, companies are positioned for more growth, but these companies still mostly pay a dividend. Again, it's still lower in volatility compared to the overall S&P 500 because it's not dominated by a handful of tech companies. That's where the risk is when holding an ETF like VFV, where it's really heavily weighted towards a couple of large tech companies. And then a total of 6%, okay, 3% each in the dynamic premium yield and Harvest Diversified Income Fund. These are lowish risk ETFs using covered call and covered put options. The purpose of these funds are to generate income. It's not going to get the same type of growth as if you were fully invested in an equity fund. These ones generate around a 7% annual yield. Then another 3% in XDIV. This is the iShares Core MSCI Canadian Quality Index ETF. These are quality dividend paying Canadian companies. 3% in Invesco QQQ, which is US based. Historically, QQQ has outperformed the S&P 500. It's still tech heavy with about 61% concentrated in tech stocks like Apple, Nvidia, Microsoft. So this is for US growth. 3% in the FTSE developed all cap ETF for international exposure. Remember, you still want international diversification. Now on to the fixed income portion of the portfolio. 10% in two of Lysander's bond funds. So these are bond mutual funds. They're not publicly traded. They're actively managed. So when investing in bonds, we want to make sure it generates yield. These funds are roughly yielding around 4 to 6% per year. They're predictable. They're considered low risk. They provide recurring income. They're not correlated to the stock market. Bonds do their own thing. The stock market does their own thing. We don't want that correlation. This is how we diversify out of the stock market. Bonds carry a different type of risk, like interest rate risk, duration risk, default risk. It can get a lot more complex, and managers are constantly trying to find yield, especially when interest rates drop. So it's very beneficial to have these types of funds be more actively managed. Active management with bond funds is, in my opinion, very important. So 15% in bond mutual funds, 5% in the Purpose Credit Opportunities Fund. This is an ETF. 2% in the Global X Active Fixed Income Fund. That is a global bond ETF. And 5% in structured notes. So structured notes are considered low risk. They pay recurring income. The interest rates are generally higher than that of bond funds. It has downside protective measures. It's called a barrier. And lastly, 10% in alternative investments. So these are private funds, no more than 3% allocation per investment. A big risk to alternative funds is their liquidity. At any point, they can pause redemptions, meaning you can kick and scream all you want, but the funds have a right to restrict money from being paid out for reasons like they don't want to be selling off assets like an apartment building in order to pay investors who want their money. When investing in alternative funds, you have to be ready with the mindset that at any point, these funds could lock you out from retrieving your money. Now, just because they pause redemptions, it does not mean that they will never resume them again. So a total of 4 alternative investment funds. 2 of them are in private real estate investment trusts. 1 is in private credit or private lending, and 1 is a music royalty fund. The total yield of this portfolio is roughly around 4.4%. That's just expected income from the dividends on equity funds, interest income from bond funds, and alternative funds. This does not include any sort of capital gain. Those are hard to predict, so we just don't do it. This entire portfolio is comprised of a TFSA, RSP, and a LIRA, all tax sheltered accounts, so we don't really have to worry about tax efficiency for now. Now, where are these investments going into? All the growth funds going into the TFSA. Everything else is in RSP or LIRA. That's how I invested my client's $600,000 portfolio. This follows my Cash for Life investing strategy, a framework I implement for clients at all stages of life, whether you're 20 years from retirement or you're already there. The strategy is customized to help you reach your retirement goals or any other financial goals you may have. Now, if you want clarity on your next steps and you want to know how the Cash Flow for Life investing strategy could work for you, schedule your free financial clarity call. Don't forget to like and subscribe for more videos like this.